Hello, my name is David Matkin. This video is part of a series on public financial management and is oriented towards students of public administration and public affairs. The purpose of this video is to provide an overview of the owner's equity concept from an accrual basis of accounting. If you haven't watched my videos on the financial position, assets, and liabilities concepts, I strongly encourage you to start with those videos before watching this one. One way to think of owner's equity is the economic value of an entity's assets after subtracting their liabilities. This definition shouldn't surprise you if you remember the fundamental equation of accounting, but this definition is a little too simplistic because it doesn't help us fully understand the substantive importance of owner's equity. Let's try another definition that helps us better understand what's going on inside the owner's equity variable. Owner's equity is the sum of all the financial transactions in an entity's history where economic resources were earned, which are revenues, or consumed and used up, which are expenses. Now, this definition may seem a little strange to you. Owner's equity is actually an accumulation of potentially years and years of revenues and expenses. And this should make sense if you realize that owner's equity is a little like your checking account balance. In any given day, the balance of your checking account is the summation of many deposits and withdrawals over potentially years and years. To really understand owner's equity, therefore, we need to identify when to recognize a revenue and when to recognize an expense. Let's start by looking at how revenues and expenses affect the fundamental equation of accounting. The equation at the top of the page shows that owner's equity is equal to revenues minus expenses. The next two equations substitute revenues minus expenses into the fundamental equation of accounting. Let's take a closer look at how we record a revenue or an expense. A revenue is a recognition of an earned resource in the time period when the resource is earned, and an expense is the consumption of a resource in the time period when the consumption is recognized. You'll need to note here a key component of both revenues and expenses is that they attempt to capture the time period when economic resources are earned and when they're consumed. Let's look more closely at revenues. Revenues are recognized in three ways. The first way is when an entity's total asset value increases without creating an offsetting liability. Trading one asset account for another does not increase the total asset value, so there are no earnings. And borrowing a resource is not the same as earning it either. Common examples of a new asset that's received free and clear of claims are donations, grants, taxes, profits from sale of goods, increases to the market value of investment assets, and more. The second way a revenue can be recognized is when a liability is forgiven. When this happens, the asset values that used to be obligated to outside entities are now free and clear, and therefore increase the owner's equity. The third way, which is most common in nonprofits, is when revenues are recorded to recognize the value of qualified in-kind services at the same time as an in-kind expense is also recorded. These types of transactions do not change an organization's financial position, but they are recorded to more accurately reflect the true cost of necessary services and where the resources are coming from to perform those services. Here's a list of some common types of revenues that we see in public organizations. Revenues from service provision, donations, taxes, fees, grants, and interest. Expenses are recognized in three ways. First, expenses are recognized when an entity consumes or uses up its economic resource. Sometimes this happens when resources are physically consumed, like using up supplies or fuel reserves. Other times, the consumption of assets is best understood as an accounting event, a way to recognize that an asset's value has decreased, even when there was no transaction with another party. Examples include depreciation of long-term capital assets or the recognition that some receivables will not be collected. The second way an expense is recognized is when an entity becomes obligated to consume its economic resources. This happens when an entity receives services and is billed for those services. This increases their liabilities as well as decreases their owner's equity. The third way an expense is recognized is the in-kind revenue and expense situation I described in one of the previous slides. Common types of expenses in public organizations include service expenses, donation and grant expenses, wage expenses, cost of goods sold, bad debt expenses when we recognize that some of our receivables are not going to be collected, depreciation expenses when we recognize the consumption of our capital assets, and interest expenses. Thank you for watching this video. I hope this helps you understand the owner's equity concept a little better.